In the financial media, you may have noticed a particular three-letter term pop up quite often: ESG. Whether it was an article or a press release or some sort of media-related conversation around this term, it's been ESG this or ESG that or all the craze about ESG. I found that in 2020, the conversations around this term have particularly intensified. If you don't know what I'm talking about, just kick back, crack open a sustainably produced cold one from a climate-friendly company, and let's talk about it. This is why everyone's talking about ESG investing. But before we go any further, what the heck is ESG anyway? Well, it's an acronym that can be broken down into three parts: environmental, social, governance. Really, a lot of areas fall under the broad umbrella that is ESG investing, like energy efficiency, greenhouse gas emissions, staff turnover, training and qualification, maturity of workforce, corruption, and revenues from new product. The list goes on. When it comes to ESG, most of the conversation centers around climate change, but the reality is it actually covers a lot more than that. I'm not going to cover all of the areas in this video. I'm just going to look at what has been at the forefront of these conversations and what has broadly informed the new policy changes that we're seeing recently. ESG is mostly about how companies include environmental concerns and labor laws in their investment strategies and actually promote sustainability as well as profits. For example, it could be investing in a company that doesn't contribute to climate change and, in fact, actually finds solutions to combat it. It may also mean that some investors will avoid certain companies that operate in certain industries, like any company operating in the fossil fuel industry. Companies that participate in ESG practices usually outline their strategies in their annual report or have a separate sustainability report that goes into more detail about the environmental and social impacts of their day-to-day activities. These reports are also used to list out their priorities and communicate these priorities to shareholders. If these priorities line up, then cool, let's do business. It's not just companies, there are a few exchange-traded funds that engage in these sustainable practices that have been doing pretty well this year. Here are a few of the top ESG performers according to ETF.com. The goal is to generate long-term returns and promote a more habitable planet where human rights aren't violated, so when it's done well, it's a win-win. This video is going to talk a lot about climate change, obviously, and first and foremost, I'm not here to talk about the different views of climate change. I'm not here to debate. I'm just going to address some of the concerns that the private sector flagged regarding climate change and its impacts towards their industries, their business, etc. But if you have intense opinions about it, then I strongly encourage you to write that all out in an email and then send that nonsense to yourself so you can get a first-hand account on what it's like to get unwarranted political views from a complete ass. Alright, now that we know what ESG is, let's find out why it has been all the rage during these last few years. First, a bit more background. The term ESG was first coined in a report called Who Cares Wins. It was the first comprehensive report that brought together people in the financial space, such as investors, analysts, and asset managers, with global consultants and governments so that we can actually begin exploring the impacts of environment, social factors, and corporate governance in driving value for companies and making the world a more sustainable place. What emerged wasn't a room full of corporate stiffs magically sitting in a circle singing Kumbaya, but it did give rise to an investment practice that is on track to have about 45 trillion in assets under management by the end of 2020. Furthermore, a Morningstar sustainability report found that ETFs and mutual funds that had ESG sustainable practices raked in 20 billion in total new assets in 2019. This blew way past the previous 2018 record of 5.5 billion. Take a look at that chart. Jesus H. In recent years, it's not uncommon to see professionals with a job title ESG analyst or something to that effect, showing that this hasn't just been a value-creating venture for companies, but it's been a pretty viable job creator as well. With these trends, it's really not hard to see why so many investors are very enthusiastic about ESG. Actually, a Morgan Stanley survey found that 85% of individual investors were interested in sustainable investment strategies. Millennials were the most enthusiastic with a 95% interest. There are also a lot of leading market voices out there who are very vocal proponents of ESG investing and warned of the material impacts that climate change was sure to have on the financial markets. One guy that comes to mind is former Bank of Canada Governor Mark Carney. The often dubbed banking rock star was very vocal about companies needing to actually change their investment strategies and came down hard on companies that have failed to introduce any meaningful measures that would have made them more sustainable moving forward. This year, he's back in Canada after serving as the Bank of England governor, and fittingly, he said that he was going to be heading the ESG investment team at Brookfield Asset Management. While ESG investing has been a really hot topic in financial circles, this year it got a renewed sense of interest. Some are even wondering if the pandemic kind of presents a turning point for the practice altogether. A quick cursory Google search of ESG COVID-19 will yield many results of banks and companies discussing how they'll be continuing to monitor the COVID-19 trends and put a renewed sense of focus on the pandemic in their ESG strategies. Remember that chart I showed you in the last segment about how ESG investing broke a new record in 2019? Well, take a look at this chart about how ESG investing is doing in 2020. So far, ESG-inspired funds in the US have been seeing some new record-breaking returns. I understand that this refers to the first quarter of 2020 and it doesn't fully reflect the impacts of COVID-19, so I'm going to turn your attention towards a report by the National Bureau of Economic Research, which found that funds with a higher sustainability rating outperformed those with a low sustainability rating during the pandemic. The pandemic showed us how companies respond to a crisis, and this brought the conversation of corporate governance to the forefront. One silver lining in this awful pandemic is how often we've heard of these stories of social cohesion and communities coming together. Some companies are kind of following the same trend. That is, if they're well managed, they can keep a stable ship, so to speak. Deutsche Bank research found that corporate ESG targets have changed over the course of the pandemic, putting employee wellness at the top of their priority list. This makes perfect sense since this has been a very emotionally taxing year for a lot of workers. And if you're part of a company that unfortunately had to restructure because its revenues were being hammered during the pandemic, then keeping that morale up is definitely that much more important. Of course, one of the greatest ironies during this whole crisis is just how well the stock market has been performing despite the stark economic fallout of the COVID-19 pandemic. I suppose that ESG companies would be part of this run-up. As we're staring at a likely K-shaped recovery at the other side of this pandemic where wealth divides are more evident than ever, it's no surprise that the focus has also been on social development. While corporate governance and social progress has been at the forefront of a lot of businesses' ESG strategies this year, it really doesn't mean that green initiatives and climate change have taken a back seat. In fact, a lot of financial institutions and governments included climate talk in their recovery plans. So I live in Canada, and I currently have a government that's been very vocal about climate change policies, and this really hasn't changed during the pandemic. This month, Prime Minister Justin Trudeau pledged $10 billion to create 60,000 jobs in infrastructure development. This would involve a 3-year plan to funnel money into infrastructure projects that prioritize areas like power generation, zero-emission transit, broadband internet access, and irrigation infrastructure for Western Canadian farmers. The government also made climate change one of the central pillars of their recovery strategy during the throne speech. Governor General Julie Payette said, "Climate action will be a cornerstone of our plan to support and create 1 million jobs across the country. This is where the world is going. Global consumers and investors are demanding and rewarding climate action. With this amount of federal interest in climate-conscious projects, there might be more opportunities for sustainable investing moving forward." But it isn't just the Liberal Party. The Bank of Canada also included a section on climate change in its own speech this month. Bank of Canada Governor Tiff Macklem gave a speech about COVID-19 and the financial system, addressing some concerns about the second wave and the impacts surrounding low interest rates down the road. Among other risks, Macklem also explained that banks have to be more transparent about their exposure to climate change risks and need to communicate these risks to their investors.
Let me say a few words about a longer-term risk that is accelerating: the impact of climate change and the transition to a low-carbon economy. The financial system has a critical role to play to support the real economy through the transition and to help businesses and households manage new climate risk. Companies need reliable, consistent, and comparable ways to measure and state their exposures to climate risks. Financial institutions, too, must understand and be transparent about their exposures. Investors are increasingly demanding this transparency. If we're going to do a better job assessing, pricing, and managing climate risks, we need better and more decision-useful information that combines climate data with economic and financial information. This will make the financial system and the real economy more resilient.
Macklem went into more detail on the Bank of Canada's work to explore scenario analysis as well as the economic and financial risks from climate change. This included both physical and transition risks, the transition being to a low-carbon economy. Some of these impacts, the bank's report explained, include severe weather events that would do damage to infrastructure or real estate. These weather events, like storms and wildfires, were likely made worse because of climate change. The concerns surrounding wildfires are definitely warranted. In a past life, when I worked as a business writer for a credit rating firm, I worked on this one research report looking at the impacts of the 2016 Fort McMurray wildfires and the 2018 BC wildfires, and the effects that those disastrous events had on surrounding businesses and infrastructure. Analysts at the firm found that the loss estimate for the local surrounding businesses ranged from 1.9 to 5.8 billion. That's a lot of insured losses that someone has to cover. To add to that, a report released at the time found that the total economic losses stemming from the Fort McMurray wildfire reached nearly $10 billion. If that doesn't spell out material risks, I don't know what else does. So this is why a lot of companies and institutions are paying closer attention to climate change and working that into their own investment strategies. Of course, transitioning to a low-carbon economy won't be cheap, and a lot of industries are going to struggle with it. They're not going to be impacted equally with this change. It's another concern that the bank brought up, and it's one that really can't be ignored. What I'm trying to capture here is just how interested the government and banks are in sustainable investment strategies. Well, at least that's been the case in Canada. Though I would argue that in the US, in the private sector, there's definitely interest in sustainable investment strategies. With this much focus and backing, you could argue that ESG investing would be better positioned to withstand the impacts of COVID-19 and will probably hit the ground running on the other side of this pandemic. It's not easy being green, and that's definitely the case when you're transitioning to a low-carbon economy. Reducing emissions as the global demand for energy increases, transitioning a workforce that's accustomed to fossil fuel industries to something a little bit more greener, and just all the costs associated with infrastructure development are all hurdles that the government and the private sector are going to have to take into account if they're going to turn their ESG investment practices into something more actionable. But with established interest and proven returns, 2020 could be a pivotal year where companies change not only their ESG investment priorities, but just how they govern themselves and how they actually strategize their practices moving forward. All right, well, I think I pretty much covered everything loosely without getting too far into the weeds about any specific area about ESG. Hopefully it gave a thorough rundown of what it is and how 2020 is kind of changing the conversation a bit. There's a lot of further reading in ESG investing, and I know in my case I've been watching a lot of speeches and interviews, including Mark Carney explaining his own stance on ESG investing and the material impacts he sort of foresees happening to certain industries in the financial sector. It's all very interesting. You should go check it out. Personally, I think it's great that the private sector is taking greater strides in adapting their strategy to focus on climate change and human rights. I think that what they have planned here isn't just hollow platitudes that we keep hearing from corporate PR strategies, but it's actually something that's more actionable and something more concrete, so we can actually see some results come out of these. So I'm going to wrap it up here and say goodbye. You don't have to go home, but you can't stay here. This has been Stephanie Hughes, and she is signing off. Bye.